I'm happy to be here today to talk to you about the Comptroller's office. It's one that is underutilized and underappreciated, but it has the potential power to do so much good, to fix so many of the vexing fiscal problems in New York State, and to do so unilaterally. And I could talk to you ad nauseum and at length about all of those powers, but I wanted to take the opportunity today to talk and really focus about one of those powers, one of the roles of the office that could do a lot of good, and that is the office's role as the sole fiduciary of the state's $200 billion pension fund. I figured if there's one group that might be interested in deep discussions of actuarial matters and methodologies, it'd be the Business Council. And for those of you who aren't as passionate about this as I am, I hope you're well caffeinated. So with that, I also want to mention that I am running for office, and the office, while a political one, I would argue shouldn't be. The skill set required to run a $200 billion pension fund are those that are largely acquired in the private sector. I don't think the office should be run by a politician. The current office holder, who you heard from earlier, was of course appointed to the office over the objection of every editorial board in New York State, because as the governor of his own party said at the time, he is totally and thoroughly unqualified. And he has since done a number of things with the office which has failed to use its powers to really fix New York State, and has rather gone along with the status quo, and he has mismanaged the pension funds in ways that I'd like to discuss. So with that, let's see if this works. The public pension crisis in America is a systemic one. There's a structural problem with defined benefit pension plans. And at the state and local level, according to the best estimates, there are $5 trillion in public pension deficits in America. If you compare that to the US GDP, it's a big chunk. And if you compare it to all of the bailouts, if you include TARP, AIG, the S&L bailout, the autos, Fannie Mae and Freddie Mac, you're still only looking at $700 billion compared to $5 trillion. The magnitude of the public pension crisis in America means that inevitably this is going to end in tears. Oftentimes when there's a financial crisis, it all seems obvious in the aftermath. And this is one time in particular where you could look ahead and you could see that this is coming, because the pension promises that we owe retirees are largely inviolate. We have to cover those. And a bailout will mean an economic crisis that we'll have to reckon with, and it'll have a large impact on the economy. Now, if any of you are sitting there thinking about, well, geez, that's interesting. I know a lot of people profited in the housing market. How could I profit if I know that there's an economic crisis coming? First of all, don't feel guilty about wanting to profit on the backs of retirees whose pensions are at risk. I thought about it as well. Unfortunately, or fortunately, you can't short the muni market. It's a liquidity issue. We could talk about why. So I haven't figured out how to profit on this, but I certainly have worried about it quite a lot. Now, the Comptroller claims, and he claimed it today as well, but he likes to say that the fund has consistently been ranked as the best managed and best funded pension plans in the nation. And if you Google this, you'll actually get about 150 hits. And again, he said it this morning, although I noticed this morning when he said it, he excluded best managed, and he just said best funded, whereas he's always usually said best managed. And that's interesting because no third party, and I've been saying this over the course of my campaign, has ever ranked this public pension fund as the best managed anything. Well, I mean, how would you even rank something as well managed as a fund? And so to focus on this for a little bit, I'd like to just think about it as a thought experiment, what a well-managed fund would mean. And I think for any fund, when you talk about it being well-managed, you're going to talk about the investment returns. And so that's what he's obviously referring to. And so that's what I want to focus on. In terms of how the $200 billion pension fund has performed under DiNapoli, there are three objective measures, right, that you have to think about. One is, how did it perform against expectations? And also, why is that important? We'll talk about that in a minute. And then the second criteria I think you have to think about when you want to judge whether or not the fund has been well managed is how it performed against other funds of similar size, other public pension funds in America. And then the third criterion, which you should talk about and think about when you judge how the pension fund has been managed, is how it's done against standard benchmarks in each asset class, right? So those are the three reasonable objective measures that we should look at and that I want to talk about. And of course, I agree with DiNapoli when I talk about the public pension funds management and his spokesperson, who says at the end of the day, it's about how you performed in office, and I couldn't agree more. So in terms of expectations, the first criterion, how you judge the pension fund's performance, It's important to remember how public pension fund accounting works, because public pension fund assume a rate of return going forward in order to cover the long-term liabilities of our retirees, of the 1.1 million members in our state's pension fund. And when the comptroller first got into office, the expectation on the return was 8%. Now, the comptroller has since lowered that return expectation over time, over the 10, 11 years he's been in office. And if you take the weighted expectation of returns over the time the comptroller's been in office, he's basically expected 7.54% returns on the assets that the public pension fund has at his disposal to invest. So that's 7.54% over the 11 plus years or so that he's expected. And so long as he hits that bogey, then he covers the liabilities, the promises that we owe retirees. And so that expectation is important. And the public pension trustee sets that expectation. So how has he done against expectations? Well, over the course of the 10 years for which we have audited data, he's only done about 5.6%. And he admits that in certain public disclosures, which he's made a little bit less public since the campaign started, but that's okay. And then, of course, the last 4 quarters, he did pretty well. And so that increased his actual earnings, so that over the 11 plus years he's been in office, he's earned about 6% while expecting 7.54%. That's a significant delta when you're talking about a $200 billion pension fund, and it means an incredible amount of deficits. How much? $65.4 billion worth. So the comptroller's missed his expected earnings on the public pension fund by $65 billion. So how was the comptroller done against expectations? Well, not so great. Now, when I pointed this out, his spokesperson responded that including the Great Recession in judging the comptroller's investment performance is cherry picking, under the theory that I guess in finance you get to call mulligans. Imagine if you talk to your fund investor, your own money manager, and when he talked about his returns and his performance for you, he said, well, you can't include the Great Recession. We can only really judge my performance based upon how I've done in times of economic prosperity and increases. Well, that's not fair. I would argue that by judging the comptroller's entire tenure, you'd have to include down years and include the Great Recession, and that to exclude it would be cherry picking. The second criterion I talked about in terms of how you judge how the pension fund performed would be against other large pension funds of similar size, right? And so this comptroller has played an interesting game. Each and every quarter or every year that he discloses how the pension fund has done, he has consistently said that the fund has consistently been ranked among the best funded and most well-managed pension funds in the country, but he has never really measured his own performance next to other public pension funds. So why hasn't the political press done it for him? Well, a couple reasons. One, with apologies to my friends who are in the political press, some of whom remain, the financial literacy of the New York City press and the New York State press is not as deep as I would like. And the other reason why nobody's ever called him on this and really compared the public pension fund's performance to other public pension funds of similar size is because New York State has a strange fiscal year, right? We end on March 31st. Whereas most public pension funds and most state fiscal years end on calendar years or June 30 fiscal years. And so to compare returns from fund to fund is comparing apples to oranges. Unless you can synthetically tie out a March 31st fiscal year for other large public pension funds, in which case you'd have to go through returns for large pension funds on a quarterly basis to synthetically construct a March 31st fiscal year for aggregate other funds. Long story short, we did it. My campaign did it. And so for the first time, we released publicly the fact that the New York State Pension Fund has underperformed the median for other public pension funds. And what you see in the first column is pension funds of $10 billion or more. The second column is pension funds of $25 billion or more. And the third column is funds of $50 billion or more. The New York State Pension Fund, its asset returns underperform them all, putting the lie to the idea that the fund could possibly be among the best managed in the country. And then the third criteria I talked about, remember, is how the public pension fund in New York State did against benchmarks, standard benchmarks. And here I interjected. This is the response from the comptroller's office when I pointed out my second finding. The Pew Charitable Trust has ranked the New York Pension Fund as one of the strongest in the country. Pew doesn't rank anything. I actually worked with the folks at Pew. They tapped me to be part of a SWAT team of pension professionals to run around the country and help provide assistance and reforms to some of the most fiscally distressed pension funds in the country. With Pew, I helped restructure one of the most distressed public safety funds in the country in Jacksonville, Florida. And it was at the time the most comprehensive pension restructuring in America. The people who work at Pew don't rank anything. They do report what states and cities themselves report, and they put it up in a table of sorts, which is not ranked by funded levels. It's actually alphabetical, and it's all self-reported. So I don't have time to talk to you about all of the investment classes that the public pension fund is in. It's a $200 billion pension fund. They're in a lot. And so I can't really compare. I don't have the time to go through each asset class to compare it to a standard benchmark. And the Comptroller's own disclosures in this regard in the complete annual financial reports, which are known as CAFRs, are unintelligible. I mean, we poured through those things, and there are benchmarks that the Comptroller tries to compare or pretends to compare his own performance to, and it's impossible to follow. The years are off. They don't use the March 31st fiscal years for most of the benchmarks. It's a bunch of hogwash. So what I did do for the presentation today is I wanted to point out that the Comptroller is overexposed in alternative funds. And the reason the Comptroller is overexposed in alternative funds is a structural problem in public pension funds today, right? If you assume a high rate of return, which you're incentivized to do in order to show that you've actually funded the pension fund's liabilities, then you got to chase risk, which means you got to go into hedge funds and private equity funds and opportunistic funds and real estate funds, because they're the ones that promised you returns. And so our Comptroller has 20% of the assets in the pension fund in things like hedge funds and private equity funds. And what's the problem with that? Well, they're opaque, for one thing. For another thing, they charge an arm and a leg, right? They charge the traditional 2 and 20 structure. 2% of money under management, 20% of profits. And the Comptroller doesn't really disclose most of those fees. He does disclose the management fees, but he really hasn't historically disclosed any of the profit fees, which are also known as carried interest. And so if you look at, taking into account fees, the Comptroller's portfolio of hedge funds over his time in office, you'll see that he not only missed the benchmark of other hedge funds have had a tough time over the last 10 years, right? The standard benchmark for a basket of hedge funds has performed about 3.3% compounded annually over the last 10 years. The Comptroller's hedge funds portfolio performed 66 basis points net of fees. The S&P 500 did about 7.5%. So the Comptroller's performance on the hedge fund side of his portfolio did 66 basis points against 7.5% if he had just invested passively in an index of S&P 500 companies. And the value that he lost because of that equates to $7.8 billion. That's $7.8 billion of value that could have gone to retirees and taxpayers that we lost because the Comptroller put money into hedge funds. So hedge funds had a tough time over the last 10 years, but of course we know private equity, the market was frothy, right? Now, it's not the case that private equity is going to have the same bull run in the next 10 years that it had over the last 10 years for reasons we can talk about, including, money's more expensive, interest rates are higher, and also it's just not as inefficient of a market. Private equity, so much money's in private equity now, private equity funds have picked over inefficient, underperforming companies. And there just isn't a lot of alpha to be found in the private equity markets anymore. In any event, though, they had a good run, and the Comptroller was in private equity. But if you fold the this is the Comptroller's response to my criticisms on his hedge fund investments. Trichter's critique is Trump-like nonsense, which I thought was not particularly substantive or fair. Let me digress for a minute. Let me walk back. The Comptroller points out that he has received a number of awards for transparency and financial reporting, and this is true. And a lot of what I'm charging isn't disclosed publicly, and it's because I think the public pension fund system in general, and the Comptroller in particular, has been much less than transparent. His response is that they've won awards for transparency. This is, in fact, one of the awards that they've won for transparency. It's at the front of the CAFR reports in New York State. However, the Government Finance Officers Association, which gives out these awards, give them out to over 4,100 reporting entities and agencies. They are the equivalent of participation trophies for millennials. They gave one out to Illinois. They gave one out to Puerto Rico. Now remember, Puerto Rico reported that it couldn't cover $75 billion in debt. That was front page of the New York Times when the governor mentioned that. It was only 2 weeks later that everybody figured out, after pouring through the Caffers, despite the fact that they had won such an award, that there was another $49 billion in pension debt that nobody knew about. They gave one to Detroit. Detroit reported about $640 million in pension debts at the point it was toying with Chapter 9 bankruptcy. Turns out their pension debts were $3.5 billion. Detroit was at risk for selling its artwork in order to cover that debt, and they would have had to if not for some philanthropies that stepped in. These are the entities that won these transparency awards. They are worthless. Now, getting back to DiNapoli and public disclosure. So the problem with hedge funds and private equity funds and why they don't yield as much as, or aren't as prudent as, let's say, a passive investment in, that you would yourself in your own 401k would invest in via S&P 500, at virtually cost-free passive index, is because of the fees, right? 2 and 20 structure. And I pointed out that the comptroller didn't report the carried interest fees. In fact, in 2015, Eric Enquist at Cranes, New York, asked the comptroller if he could justify the $2.5 billion at that point that Eric Enquist thought the comptroller had paid to alternative fund managers. And the comptroller responded at the public Cranes breakfast that that sounded too high. In fact, it was way too low at the time. That was in 2015. We computed for the first time the amount of fees that the comptroller has paid to hedge fund managers and private equity fund managers by backing into the carried interest fees that he would have had to have paid. Not that he disclosed them, but we could figure it out through some forensic accounting of sorts. And it turns out that the comptroller has paid over $6 billion to hedge funds and private equity funds and alternative asset managers since he's been in office in 2007. And if that sounds like a lot, it's only because it is. And that's on top of the $7.8 billion in value he'd lost by not investing in passive S&P 500 indexes or the broader markets. So I call the comptroller the $6 billion man. Now, if you don't believe me in terms of investment strategies for large public pension funds, then listen to Warren Buffett, who talks about and warns about the friction of fees and how it could drag on earnings. And also think about that when you are a $200 billion fund, you kind of are the market. So why are you messing around trying to find fund managers that can outperform the market? There are very few fund managers that can outperform the market when you take into account fees. And when you have $200 billion, you can't find enough of them. And so you're much better off passively investing the equity portfolio of the fund in indexes. Pay 6 basis points, virtually cost-free, and ride the market up and ride the market down. But don't give away $6 billion to Wall Street that you don't have to. Okay. So I made the point that there's a public pension crisis in America, that there's $6 trillion, I said $5 trillion in outstanding deficits, right, at the state and local level in the public pension space. It's also the case, I didn't make this point, but it's also the case that in aggregate, public pension liabilities are funded at about 70% in America. So if you take all the public pension funds in America, the state and local level, we have about 70 cents on every dollar that we owe. Right? That's the aggregate funded level. New York State, according to the comptroller, is 95% funded or 98% funded, depending on what metrics you use. And I told you we've underperformed on the asset side, on the investment side, all of those funds. So the billion-dollar question, the question that no political press can understand and the comptroller is obfuscated, is how is it that New York State's pension fund is 95, 98% funded when we've underperformed other funds that we know are only, in aggregate, 70% funded? This is the question. And to understand exactly why, you have to think about how public pension funds fund themselves. There are 3 revenue streams, right? There are the investment earnings, which I've already said the state pension fund is underperformed, and I've showed it to you. It's empirical. I've used empirical data to show you that. There are employee contributions, which are very low in New York State. For many employees in the public pension system, they pay nothing in employee contributions. For the majority in Tier 3 and 4, they pay 3% for the first 10 years and nothing afterwards. And for Tier 6, for new employees, well, they get squeezed. We'll talk about them, but there aren't a lot of those. The last revenue stream is employer contributions. What are employer contributions? Ultimately, they're taxes. They're the contributions that local counties, local cities, and local special districts and jurisdictions pay on top of all the salaries they pay to their public employees. And they translate into taxes because the local jurisdictions have to collect those revenues via taxes, property taxes or other taxes, et cetera. And so what you see here is the aggregate of the 100 largest state and local pensions in America, and then all of the public pensions in America, and how much their employer contributions have increased since 2002. And the bottom line is inflation. So employer contributions have increased in America since 2002, way over inflation, and even so, in aggregate, public pensions are only funded at about 70%. New York State, funded at 95%, has been much more aggressive in collecting employer contributions. In other words, they've been much more aggressive in taxing to make up for the investment shortfalls of this comptroller. How much more aggressive? I'm going to show you. I'm going to overlap the line of employer contributions from New York State since 2002. I apologize for those of you sitting in the back who might have to squint to see what the delta is, but as you can see, if you can just make it out, oh my God, look at that, refuted thus. This is how much more New York State has collected in employer contributions than other public pension funds in America. It's not even close. It's the $65 billion writ large. Our comptroller has funded our pension fund at 95, 98% because he's taxed more. And his fingerprints are far enough removed that he's gotten away with it, and very few people know about it. And the reason for this is somewhat structural, and I can get into this, and this is an actuarial complexity that might be of very little interest to you on a Monday morning. But the method of paying down our pension debt, our unfunded liability in New York State, is very aggressive. It's the accrued cost method. Most other public pension funds use the earned entry age method or a PUC method, et cetera. But we're much more aggressive in New York. And what that does is supply a backstop to our chief investment officer, Tom DiNapoli, for covering up his shortfalls. And so nobody knows about it. It's hard running for comptroller against a New York State incumbent, I'll tell you that. This was the comptroller's response. It's not surprising that a guy who just joined the party of Donald Trump is now trafficking in fake news to get attention. Folks, if I were trafficking in fake news, I'd come up with better stuff than this. And this has stress, right? This really does stress localities. So you can't see this, but I'll make this presentation available to anybody who wants. These are localities whose employer contributions have increased since 2002. In here is Syracuse, which in 2013 and 2014 saw their employer contributions jump by about 124, 126%. This is what drove Stephanie Miner to cut her municipal workforce by 10%. To start selling city assets, to beg nonprofit institutions in Syracuse like the university to start contributing property taxes, and also likely drove her to run against Andrew Cuomo. Now, remember at the beginning I said that there's a quirk in public pension accounting that you can cover your liabilities and effectively say that you're funded so long as you assume your rate of return at a level sufficient to cover those liabilities. So our comptroller, when he talks about the fund being 95% funded, is assuming that he will return 7% each and every year. That's how you get to the 94.5% funded level. New GASB regulations require a sensitivity analysis such that public pensions have to disclose what they would be funded at if they only earned 6%, which we know DiNapoli, over the course of his 11-year tenure, actually earned. And if you assume 6% going forward, which going forward is optimistic, the fund is only 82% funded. And if you assume 5.6%, 5.59%, which is what he actually earned over the past 10, 11 years, it's only 81% funded. And if you take into account fees, which he doesn't disclose, it's only 78.6% funded. This is why the pension fund in America is in such trouble. This is why Puerto Rico and Detroit sneaks up on us, and we don't see it coming. Because public pension accounting allows you to obfuscate these things. And on the other side of this slide, I point out how much pension debt that means that New York has. Assuming that we earn 6.6% flat, we have another $36 billion in off-balance sheet pension debt. The private sector analog of this is the special purpose vehicle that Enron used to park debt from its accountants so nobody would see it. It's an accounting practice that did not end well. I also want to talk a little bit about the fact that the comptroller plays politics with the pension fund. As a sole fiduciary, he is responsible for maximizing returns for retirees, period, full stop. But our comptroller likes to put himself at the vanguard of certain political movements, including environmental sustainability and therefore divestiture, carbon divestiture. And so he's created, or he asked Goldman Sachs to create a bespoke carbon index, which he calls a low carbon index, which is supposed to mirror the broader markets. And this year he pledged to invest $4 billion in the index at a cost that he refuses to disclose. Goldman Sachs is not a nonprofit. They're charging him something. And at the same time, on the other hand, Exxon remains one of the top equity holdings in the pension fund, along with 50 other high carbon emitters, which means that on the one hand, we're paying Goldman Sachs some undisclosed fee so that Tom DiNapoli could tell his political supporters that he's an environmental activist, while we're paying Goldman Sachs for the opportunity for him to do that, while we're also invested in high carbon emitters up the wazoo. I'm going to skip a little bit more about this because I think I'm running out of time. Most recently, last week, he wrote a letter to McDonald's warning them of the reputational risk for killing chickens and treating them inhumanely to make their McNuggets while holding $300 million worth of McDonald's stock. And he's gone after other companies accordingly. The last thing I'll say is that in 2013, despite the fact that we're supposed to have a fully funded pension system, there was some pension belt tightening because of the stress on local employers that the contributions were causing. And they created a new tier of employees, Tier 6, and it was inequitable. Effectively, in Tier 6, only 20% of the retirement benefits are being supplied by the employer, by the state, or by the public workforce where these employers are employed, whereas everybody prior to the Tier 6 workers were getting 60%, 62% on average of their retiree benefits from their employers. So effectively, in 2013, the state decided to fund the very expensive, often unaffordable pension benefits in New York State on the backs of new workers in Tier 6. And one of the significant effects of this is that for the first 20 years of a new employee's work life in Tier 6, they're actually net contributors to the pension fund. And if they leave prior to 20 years, they leave without a single dollar in employer-financed retirement benefits. So as a result, I designed my own defined contribution plan, which would be an optional plan for new employees. It would be portable, so that if new employees today wanted to take with them some retirement benefit if they left prior to 19 years on the job, they would in fact have their own contributions plus some employer-financed retirement benefit that they can take with them, and it would be cost neutral because the employer contribution would be a 6% match, which is equivalent to the normal cost of the defined benefit plan, and so the state would be made whole, and our new employees would be able to leave after 19 years with something to take with them in their new jobs. So in terms of how I would run a pension system, a $200 billion pension system, first I'd be honest about its liabilities. I would be honest about the accounting of its liabilities. I would also not assume a rate of return that is greater than is realistic. And most of the time when public pension reformers like myself talk about lowering the assumed rate of return or lowering the discount rate on the liabilities, other people complain that this would mean higher taxes. This would mean stress. This would mean more employer contributions to make up for the fact that we're not pretending we're going to earn more than we really are going to earn. But there's an interesting twist in New York State. Because we so aggressively go after employer taxes whenever there's a shortfall, our current comptroller has effectively been funding the pension fund as if he were earning what he was earning, which just means that if we lower the discount rate to something realistic, if we set best practices to show an example to other pension funds around the country of what's right and how to be honest about their pension liabilities, it wouldn't actually affect local employers, and it wouldn't mean more of a tax increase than we're already taxing. Okay, I've talked way too long about pension systems and pension actuarial methodologies for a Monday morning, so I'm going to end it there. Thank you all very much. My name is Jonathan Trichter. I'm running for State Comptroller. Thank you.